Welcome to Why CBS, a podcast series for Columbia Business School. I'm your host, Fahad Ahmed, class of 2017. Since the day we were born, one way in which we learn about ourselves is by listening to the personal stories of others, narratives that tap into our emotions, creating enthusiasm and drive. In this podcast series, we bring to light these types of stories from the people of Columbia Business School, stories that are shared to teach, encourage thought, and spark action so that you can go out and create your own story. Today's lesson begins now.
If you could create products that they're able to invest in on a financial side, so fulfill their fiduciary obligation, and also have a positive impact on society, you really can change the capital market to really have people think about when they're making an investment, or entities when they're making an investment, what is being created or lost in that investment? What is the impact of that investment?
That's Clare Murray, a graduate of Columbia Business School's class of 2017. During her time at CBS, Clare, then a vice president at the investment firm BlackRock, was demonstrating herself to be one of the leading professionals in the sustainable investing field, also known as impact investing. Her success in this field has brought about big change in her life, but also great recognition. Shortly after graduating in May 2017, Clare accepted a position in Sydney, Australia as the Associate Director for the impact investing firm Leapfrog. In this role, Clare oversees strategic initiatives that facilitate growth to low-income consumers in Asia and Africa. Because of her work with Leapfrog, Clare was recently recognized as one of Forbes magazine's 2018 30 Under 30 Finance and Venture Capital Professionals. In this episode, Clare takes us through the growing field of sustainable investing, her life 1 year after graduation, as well as her decisions to leave New York City and move across the world to Sydney, Australia. We begin by learning how Clare's career in this field started with her studying art history at Duke University.
Honestly, I really enjoyed history and art history in particular. And so when I was thinking about what I wanted to major in, I wasn't incredibly strategic in, okay, where do I see myself in 10 years? What do I want to be doing? It was more that I loved art, and I really, if you're going to spend most of your time taking classes in a field, I wanted it to be something I enjoyed doing. And so at the time, it was art history. And I think a part of that was I grew up in Manhattan. And so for me, art and museums were always part of my life, and somewhere I would go on weekends. And even when I was in high school, I took art history as an elective in high school, and we would go to the Metropolitan Museum of Art and the MoMA and the Whitney, and you just have all of those at your fingertips.
Were you thinking about doing an academic route in art history? What were you looking to do professionally in this field?
So I was thinking about a few different tracks. I don't think I really explored the academic side in terms of getting a PhD in a specific field within art history. I really enjoyed it. While I was in college, I worked or volunteered at the Nasher, which is a museum connected to Duke. And I volunteered there as a docent, so as a tour guide for elementary school students in the local area coming to the museum. But I also then got involved on the management side of the museum. I personally was not managing the museum, but I got to see how a museum ran, and that side really interested me.
So then how did you get into the finance side of things?
Yeah, and actually it's interesting we're talking about museums, because during my junior year in college, I was on a whale watching trip as a vacation. It was a crazy spring break with my family. And I met it was organized by an environmental nonprofit, Natural Resource Defense Council. And on this trip was a woman who was the CFO, so the chief financial officer of the Metropolitan Museum of Art. And I chatted with her briefly, but and she definitely will not remember this conversation, but it was really memorable and transformative for me, because it was the first time that I recognized that there's this combination of finance and art management, and there are actually roles in that. And so I really liked the management side. I'd already seen that at Duke with the museum there. And this woman had come from the traditional finance route. She'd worked at an investment bank and then crossed over to the art world as CFO. And so that really crystallized in my mind that, you could enter the world, potentially the world of art management at a later stage. And so I thought, okay, I'm going to follow her track and go the more traditional route of finance, and then build a skill set that I could then use at a museum potentially at a later point.
So after Duke, you went and you worked at Goldman, right?
Yes.
3 years there?
Yep.
And then after that, and most recently, you were at BlackRock.
Yes.
For 4 years. Much of your career, all your recognition has been around sustainable investing, impact investing. How did you get started in this field?
When I was at Goldman, I was in private wealth. And so that's managing money for individuals, high net worth individuals, as well as institutions. So I worked with some smaller foundations as well. And so that was the first time I really started working with foundations and understanding they have endowments that need to be managed so that they can, continue to do the great work that they focus on. I started focusing on this area. The reason for that was because I, in particular, was working with some environmental nonprofits. And on the one side, they're suing Exxon or BP, for some sort of natural disaster that occurred. And so that's going on with their grant side and what they're doing at the core of their mission. But then in their endowment, so in their investable pool of assets, they were investing in those products or in those companies. And so the two sides weren't talking. And I got involved because I was already talking to the people running their endowments and helping to help them think about better aligning mission with corpus. So what they were doing was in line with how they were investing and vice versa. And sustainable investing, just to explain it to anyone who might not be familiar with that, is really this idea of doing good financially and benefiting society. It's this idea that you can have strong financial returns, but then also have a positive impact on society.
And so when a person is looking to invest, I think just traditionally, right? Let's take out the impact investment part of things. They're looking at financial metrics such as sales growth, cash flow, market share, valuation, right?
Yes.
When it comes to the impact investing side, what else are they looking at?
Yeah, and you're right. So it is everything you touched on the financial side as well as other metrics. And what's interesting about impact investing, and which is why I love working with clients and understanding what their needs are, is impact can mean different things to different people. An environmental nonprofit, for instance, likely really is passionate about mitigating climate change or, protecting land and
Air
water.
quality,
Water resources.
Right.
So for an environmental nonprofit, it's probably more on the environmental side that they want an impact. Maybe they don't put as much emphasis on job creation or other things, whereas like a nonprofit that cares about poverty is going to really think about creating high quality and high paying jobs for people. So impact can really mean a ton of different things. And so it's really about what the end client wants. But in terms of what you would measure, it could be everything from, so on an environmental side, like carbon usage or, with Tesla, for instance, it's obviously considered a really great company. There's been some work or pushback on them because their batteries are actually quite harmful for the environment. And so it's this great company, but there's things that can still be done. And so that's something that Tesla's worked to try to address, for instance.
So it's environmental, there's a social side of things. Isn't there also a governance side as well?
Yeah.
What is that?
Governance means how a company is run. That's from everything from checks and balances. So what is the board responsible for? Who is the CEO accountable to? At a public company, shareholders are what the board is responsible for. One component of governance that is getting a lot of work's being done and actually some regulations occurring in some countries, not in the US right now. But this idea of having more women on the board, having equal pay for similar roles at, within a firm, at different genders. It's having the right legal checks and balances in place. So governance is also a business decision. Like all of these, so the environmental, social, and governance side are areas in themselves, but are also good business decisions. So good governance is ultimately going to help a company on the financial side as well as on the positives.
So it's a focus on these three things plus the financial return that makes it a sustainable investing strategy.
Yes.
Is there a sacrifice on the return side of things? Have you seen that? I mean, it's great, right? It feels good to be able to put your money in particular companies that are doing good for the environment, that are doing good socially, that have good governance structures. But have you seen, generally speaking, that there's a sacrifice that's being made financially?
There are financial products out there that run the spectrum. Grants, for instance, are foundations will give a grant. They're not expecting a return back. So that can be considered impact investing, or that can be considered positive investing. The area that I focus on is this intersection of financial returns, so non-concessionary returns, and positive impact. And that's what really excites me. And there are some products out there, but frankly, this space can and needs to continue to develop to have more products that are able to achieve both.
Claire, when you say products, what do you mean there?
So when I say products, I'm referring to investment products. So that is an equities mutual fund or an exchange traded fund on the public market side. It can be a private equity vehicle. I mean, broadly, investment strategies that clients are able to invest their capital in.
You mentioned the fact that there are some products that can hold their own on a financial reward side of things. Has it been shown to have a better short-term return? Is it a better long-term strategy?
I think where it's really shown, I think you can make the case that in the short term and in the long term, it makes sense and is able to have the financial and positive returns. In the long term is where you really see it. It sounds obvious, but good governance, for instance, is going to create a good long-term plan and stability for a company. So definitely in the long term. And it's interesting. This one area where, in terms of where products have not yet really grown in terms of the product offerings, is on the hedge fund side. And the reason for that is because hedge funds not only invest long, so buy shares of a company, they also short shares of a company. And the shorting side that's normally a shorter term investment thesis. And so that's a shorter time horizon. And that there's still work that needs to be done to show if it makes sense to short companies. So I think they're definitely on the long-term perspective, it makes a lot of sense. I think on the short, it's still being reviewed.
This is not new, right?
Actually, this idea of divestment is not new at all. And so divestment, it means this idea of asset owner. So think an individual or an institution wanting to invest their money broadly, but excluding areas that don't align with their mission. One that was incredibly powerful and kind of really was a catalyst for this space of divestment, or negative screens is what it's called, or exclusionary screens. It's when you exclude certain sectors or companies. Where this was really proven to work was in the U.S., some endowments, including Stanford, really led the charge on this, divested from South African companies during apartheid to show their objection. I was thinking lack of support. Their objection to apartheid.
Right, and Desmond Tutu was the one. He famously came out and said, "Stop investing in our companies because it's just enabling the apartheid to continue."
Exactly.
So companies take their money out, and it is a part of how you can put this economic pressure on top of moral pressures as well.
Absolutely, and one area now that's becoming that we're seeing pressure in is around gun manufacturers. So BlackRock, which is where I used to work, they are excluding gun manufacturers from their investment products for clients. And so that's a company, BlackRock, really taking a very public stance against gun companies.
You mentioned exclusionary screening. How far down do you all have to go? Is it a primary, a secondary, tertiary connection to a company that might not be connected to their mission, to the values of a particular organization?
It really depends. And I think what people want. When I was at BlackRock, I helped create an ex-fossil fuel strategy for endowments. We made a definition and had a call where our methodology, the methodology being this BlackRock product, wouldn't invest in companies that actually extracted coal, oil, and gas from the ground. So we focus on the extraction side. But you could go a lot deeper than that if you wanted to, if you were passionate about ex-fossil fuel. So it really depends. And so when you're thinking about this personally and where you want to invest your money, it is worth spending the time to actually really understand the product you're thinking about, and this could be an equities mutual fund or ETF, and understanding what it is actually, how they make their decisions on excluding certain sectors or companies.
But it's gaining notoriety, though, this idea of sustainable investing. And I saw a graph that said in in 2005, there was, I think, 1.5 trillion in sustainable investing portfolios. 2 years ago, in 2016, same graph shows that there's now 8.1 trillion in these sustainable investment portfolios. Why do you think there's been this popularity and this growth and acknowledgement for this particular type of investment strategy?
I think there's a few trends helping to drive this growth. One is as millennials come into money, whether that be through family wealth or them rising up the socioeconomic chain as they continue to work, millennials care about or are passionate about what they do care about. And so this idea of impact investing for them has gotten more popular. Women also, there's a lot of data that show that women put more weight on the impact side and doing good for society in terms of investments. And so as women have gotten more, gained more financial power, absolutely. They also are pushing this trend forward. So millennials, women, and companies in general are also are feeling more pressure to do something. And so this is one way that they're able to do that.
It's not any one person or one industry that is solely responsible for advancing and protecting environmental causes like clean air, clean water, or social causes like healthcare or housing. That said, why are institutional investors so important to the planet and also to people?
Institutional investors have a ton of money. They really are able to, me in my 401k, let's say, if I wanted to exclude tobacco companies, like, is the tobacco company really going to care? No, they're not going to notice. But these institutional players are huge owners of most companies because they invest very broadly. And so like BlackRock, for instance, is a top 5 shareholder in, I think, like 90% of all companies in the U.S. I don't think that is an exact accurate quote, but generally speaking, yeah. So when BlackRock does something, people pay attention because they're a massive shareholder. I do think institutional investors, when they take a stance, it's much more publicly known. And what's interesting about institutional investors is $3 to $4 trillion flow through the capital markets on a day-to-day basis. And institutional investors have people who work there in the boards and senior management have fiduciary obligations to create more wealth and grow the company for shareholders. That's their mandate, and that's a legal obligation. So why impact investing is really important, and this idea of non-concessionary returns is those investors are unable to invest in products that wouldn't compare or compete with other more traditional financial products. So if you're not able to hit the financial returns, then you're just not a viable option. Legally, these people are not allowed to invest in you or these organizations. So you really need to, that's why I'm really focused on why this space has grown so much, on creating investment products that don't have a trade-off.
So you mentioned BlackRock. You worked there for 4 years. You're now at a company called Leapfrog.
Yes.
Can you tell us what Leapfrog is and what you all do?
Leapfrog is an impact investing private equity firm. It invests in growth equity companies in Asia and Africa. Our thesis is on providing basic services, including financial services like insurance and healthcare services, to people living below the poverty line in their emerging markets. We call these individuals emerging consumers. It's people living between $2 and $10 a day. What's interesting about the thesis that my company has when we choose to support and back companies and take stakes in them is this idea that if you can provide high quality, affordable, and relevant products to that growing class of people, which is really the base of the pyramid, if you're thinking about the pyramid being like people at the lower income level at the bottom and then moving your way up to the 1% at the top, that's a huge market. There are 4 billion emerging consumers in the globe. In the markets we invest in, so that's in Asia and Africa, and we focus in certain countries within those two regions. That's 2 billion people. And so that's a massive segment. So if a company isn't focused on providing products to that that group of people, they're missing a huge business opportunity. So if you can provide quality products that work for those people, that those people want to put their, small amount of savings into, it's a huge economic opportunity. But then it also is on the social side, you're providing these people with financial products that they might not have had before, or healthcare products that they might not have had before.
How do you actually find these companies? Do they approach you? Do you, is it a Google search that you all do and find them? What's the, how does this work?
We employ people on the ground in the markets we invest in. So we have offices in Singapore, in Johannesburg, in Nairobi, in Lagos. And so it's really through their networks that we come across companies. I think also now my company is 10 years old. And so we're relatively well known in the impact space. And so I think because of that, we're also privileged at this point to also get inbound inquiries from companies that think taking our capital or our money would actually help them grow. And they've seen it work with other similar companies.
So BlackRock, a major player in the world, let's just put it that way. You're there, you're doing a great job. What was it that made you leave and want to go to a smaller firm like Leapfrog?
I knew while I was at BlackRock that I was really interested in sustainable investing. Like that was the area I wanted to focus my career.
Why?
Because to me, if you can create investment products, as we talked about the importance of institutional investors, like sovereign wealth funds even, or, massive players, if you can create products that they're able to invest in on a financial side, so fulfill their fiduciary obligation, and also have a positive impact on society, you really can change the capital markets to really have people think about when they're making an investment, or entities when they're making an investment, what is being created or lost in that investment? What is the impact of that investment? And because every investment has an impact, it's just positive or negative. So for me, I really wanted to work in sustainable investing to create products that had the financial return side where then institutions were able to invest, and then also was doing good for society. So the company I'm at now, Leapfrog, is focused on that. We're a private equity firm that only works within the impact investing space. I knew I wanted the private markets. That's where you can actually really interact with the companies because you have a stake in them, an investment stake, and work with them to create these positive outcomes.
Let's ask the leadership question. What's the leadership sell when it comes to impact investment? Why should leaders of organizations, if they're not already, practice a sustainable investing strategy?
I think there are a few business reasons on why too. Obviously, it's good for society. But in terms of as a business leader thinking about their own organization, it's a competitive advantage, I think, for hiring. People want purpose in their jobs, and that impact is really important. Again, impact being very broad on what is impact. But I do think you get higher talent when you're able to attract more talent as a company, when you're able to have positive impact on society and people want to work there. Like I think this sounds obvious, but like I think you're going to get more high quality people going to a firm like a Tesla versus a tobacco company. I just think like people want to work somewhere they're excited to go in to every day and that they believe what they're doing is in some way having a positive impact. I also think, and we discussed it, when I'm thinking of impact investing, it's both the investment side that they could do, but then also just how they're running their own organizations. And so good governance, as we've discussed, is a good business decision. And so if you're going to have long-term viability and have continued competitive advantages, it's good business to be aware of the environmental, social, and governance sides.
It's the future.
Yeah. And especially now as companies are thinking more long-term, there's this pressure to think long-term versus just so focused on next quarterly returns. And some companies are even moving away from quarterly reporting, for instance. It really is becoming more and more of the future.
For our innovation question, do you feel organizations who are committing to this strategy, not just in their portfolios, but also in their operations, do you feel their people are being more innovative? Do you think their strategies are getting more innovative?
Yeah, I think not only getting more innovative, but also mitigating risk better. So if you're aware of, on the environmental side, the environmental footprint of your company, you're less likely to have a PR disaster or an actual environmental disaster, not only just PR, because you're just taking more components into consideration.
You mentioned earlier that millennials and even Generation Z, they're coming in and they want to have more of an impact in everything that they do. And here is a way in which people can actually do that. They can work in these traditional finance fields, but at the same time, hit returns on a financial return side, but at the same time, make social impact as well.
Yeah, and I do think, yes, impact investing is a growing field. I talk to people who want to get into the space somehow and either come from traditional investing or just other career tracks and are trying to make a change. I do think it's worth noting that one can have impact in their job in a variety of ways. Like I particularly was focused on this financial side, on building products that had those two components. But impact can mean broadly a lot to a lot of different people. And so when I chat with people about getting into the space, I also suggest that they just think about what it is they really care about. And is there a way to do that in their day job or in their company that they're currently at versus moving companies to do that in a more defined impact investing role.
So let's ask the best business advice right here then. If somebody is looking to get into this space, in addition to what you said, is there anything else that they should take into account? Is there anything else they should be doing to get some traction and get some leverage and find themselves to be able to make an impact in this particular type of business?
Yeah, I think there's different ways to do this. I do find, given there's such a focus on the financial side in impact investing, that getting a traditional financial skill set is incredibly important. So, because everything then builds off of that. So I think getting starting at a more traditional investment player,
like Goldman, like you did, right?
Is a good place to start, and then trying to move more into that space, and that space being impact investing. If given we're doing a Columbia Business School podcast, I'll also say there are classes you can take in this space. I mean, it's a new growing field, so there aren't as many out there as hopefully there will be later on. But Columbia does have a number of impact classes. So I took one on social housing. There is coursework now, especially at the graduate level. I'm sure at the undergraduate level, I just am less close to that. that also address these topics in our way to learn about the field.
So when we first started planning out this season, Claire, we knew we wanted to have a few episodes dedicated to graduation. And this episode is part of that. It's just a profile of a student 1 year after graduation. Did you feel any pressure to push yourself a little bit after graduation because of all the work that you did? I mean, we said it before, you did the executive MBA program, so you were working full time. You're going to school every other Friday, Saturday. You made 3 changes in your life. You changed job, you changed role, and you changed locations.
Yeah.
Was this from any type of pressure you had on yourself to do something different?
I do feel that after, like when I started the executive program, I was not planning on changing jobs. Like the reason I chose to do an exec program versus a full-time program was that I really liked BlackRock and I wanted to stay there. And so this was a way to have my cake and eat it too. And looking back, I really don't know how we all did 2 years of business school in that amount of time with all the other obligations we had going on in our life. Like it's mind blowing to me that everyone found the time. And
Right.
I like now sit on a Saturday morning and just like so nice to not be like on the subway going up to Columbia at 7 a.m.
And having breakfast.
Yeah, I did enjoy the breakfast. The free breakfast made it all worth it. I did feel pressure to try something new. And once I'd identified that, what I think was great about Columbia Business School is there's so many resources you can take advantage of and use. So once I knew that I wanted to move into a sustainable investing sector and a company that was aligned with my mission, I reached out to a number of professors who were great in terms of connecting me to people. I reached out to alums, and for the most part, people were really responsive and quite open to trying to help me. So I do think there's, the great thing about Columbia, which I think somewhat does put pressure on you, is once I realized I wanted to change, there were so many resources at my fingertips to really then execute on that. I think, if I had just in my own head thought, okay, like I want to be doing this sort of work, like how do I do it? It would have been much harder for me just individually to try to pursue that strategy. Whereas like with the Career Center and all the different resources, like it actually became much more of an executable game plan to get me there. But I will say, like someone once told me, Like you're only supposed to change one of those three things at once. And I do think
right, either location, job, or role.
Yeah,
right?
exactly. And I do think that changing three was a risk because just the chances are one of those goes wrong and then it affects all the other two. For me, it's worked out, but I do think actually before making such a drastic change, it's worth it's even more necessary to do a lot of research to make sure all those three things are right, because it's just creating a lot of new variables or adding a lot of new variables to the pool.
So I get Leapfrog, great organization, completely fits with your particular mission. Was there any reservation about leaving New York, where you grew up, and going all the way out to Sydney, Australia?
Yeah, I mean, I had never been to Sydney before I moved there with my new company. Definitely some reservation. I think for me, it was more of a personal motivation. I, as you mentioned, from New York, had worked at Goldman and BlackRock in New York. I ultimately see myself back in New York. And so for me, it was, if not now, when? Like, It's just going to get harder to move abroad. And I'd always had an interest of living abroad. And so for me, it was a nice challenge where it wasn't one of my critical needs when I was thinking about the job process. I was open to international opportunities. And that's how this one came about. And I mean, in my mind, at least, no one hates Sydney. I've decided, like, everyone you talk to loves it. And I don't know what's not to like. It's you're right on the water. You're in still a city, tons to do. You're also on the other side of the world, so a lot of travel opportunities. Yeah. So for me, I thought, why not try it? And worst comes to worst, I end up back in New York.
Let's move on to our connect question. How did the curriculum at business school allow you to connect the different areas of business together to position you for the strides you're making in your career now?
For me, when I decided to go to business school, it was really to get a foundation at a very broad level of all the different parts that go into a business. Like every role has a part of marketing, a part of strategy, a part of, the financial economic side. So what I think Columbia Business School provided me with was really just getting exposure to all these different areas in a dedicated fashion. And so understanding both the abstract Porter 5 forces, like the academic side, but then also the professors themselves, like where they came from in terms of their jobs that they held prior, or, if they were adjunct professors or doing in addition to their coursework, I think really helped formalize a business foundation for me that then I was able to draw upon in my day-to-day job. And then on the impact side, I believe that some of the courses I took that were actually really targeted around impact investing were also incredibly helpful in terms of just continuing to increase my knowledge of the space.
Final question, and this is to answer the question of our podcast title, Why CBS? And maybe, get a little sentimental here because you're back from Sydney just for a couple of weeks here in New York. And if I haven't thanked you enough already, thank you very much for making the time to meet with us.
I get to see you, so of course I would.
No, it's been fantastic. 1 year later, then you're going to finish the sentence here. Okay. 1 year later, what I missed most about Columbia Business School is
all the classmates of mine.
Clare Murray, thank you so much for saying yes to this request. I really do appreciate you making the time for us. I appreciate you welcoming us to your mother's home to record this. This has been fantastic. Thank you so much. That's our episode. Before signing off, this is the part of the show where I want to share my main takeaway and ask you to do the same. My main takeaway after talking with Clare is, where and how you invest your money matters, because investment is an expression of your thoughts and your values. As Clare has told us, even in the financial markets, you can practice your values and not have to make financial sacrifices. It just takes a little bit of extra research and time to find the right financial products that fit you. What did you take away from Clare's story? Let me know. Share your thoughts by leaving a comment and rating this episode. Do you have questions from this episode you'd like follow-up on? Send those to me at ycbspodcast@gsb.columbia.edu. Thank you to Clare Murray for sharing her story, and as always, thank you for listening.